JJ, the CPA is here. Let's go, let's go. Yeah. Money, 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 money. You know what it be. Tell them all I do is work, cause money never sleep. You never met a CPA quite like me. Nah.
JJ, the CPA here. Hope you are doing well. Thanks for joining me live today. We're going to be talking about the employee retention tax credit, doing some Q&A, get caught up on a few things. So if you do have some questions related to this, put them in the comment. I'll give you a little secret. You have to be a subscriber to be able to comment during the live. So thank you so much to the subscribers. And if you haven't subscribed, I sure would love you considering it. All right. Hey, let's just get right into this. This is JJ, the CPA's Small Business Toolbox.
The combination to money making, we got this. JJ, the CPA, is the master locksmith.
All right. So, this show, I don't want it to be too instructional, but I am going to go through some things related to the employee retention tax credit. But we do have some breaking news that the Inflation Reduction Act is coming into play this week. The one thing to note about this is that I am not seeing anything that's really affecting, in essence, you, small business owners, the self-employed, as well as then just us as American taxpayers. There are provisions in there that in essence are helping those that are going to get electric vehicles. It's extending those that need financial assistance with health insurance premiums. There's really some tax provisions in there that might, for lack of a better word, raise revenue, meaning taxes for the largest of businesses, those that are doing over $1 billion. So really from this perspective, there are some tax provisions you'd probably want to be aware of, especially if you are getting into anything that's related to solar power, wind power, geothermal type pumps, electric vehicles, the hybrid plug-ins. What's interesting is that with this, it now includes used vehicles that meet those qualifications. So in the body of this video, now wait, don't go there yet, but if you haven't seen, I've done a Inflation Reduction Act tax summary video, about 5 minutes, believe it or not. But anyways, there is a link in the body of this video to that if you haven't caught it. But hey, I hope you are doing well. Where I'm at here in Oklahoma, kids are back in school, so things are getting kind of back to normal. Now, I will tell you this, I'm to the age now, 50. You're right, I don't look it at all. But I'm to the age now where I don't have any kiddos that are starting school. I've got a son that's going to be starting college, not quite the same thing. Biggest difference is we don't do any back to school shopping anymore. We don't have to go and get the number 2 pencil if they even do such a thing. But Amanda's son is a junior this year in high school, and so he's starting up. If you tuned in live last week, I sure appreciate it. We were out at the lake, kind of doing a last of the summer visit to the lake with my kiddos, with Amanda and their significants. Had a great time. Came on and kind of did a little bit of hellos to you. So thanks for tuning into that. So what is the employee retention tax credit? Oh my gosh, JJ, are we really going to get into the instructional part? I enjoy hearing what you have to say, but my gosh, I'm tired of things related to the employee retention tax credit. But let me tell you this, if you've got friends that are employers, so they have employees, it'd be worth mentioning this to them. So as you probably heard me say a few weeks ago, we had a group of what I would call YouTube family members that have risen to the level of being a part of my monthly consulting group, which is a fee to be a part of. And they are now what we call Group 51, but nonetheless had a great group that came all the way to Oklahoma City, and we were enjoying each other's company, did an all-day seminar. But one of those that came was Jim with Want a Cupcake. I don't know if you're on with us today, Jim, or were you watching? Hope you're doing well. He is up in the Seattle area, Washington State. That's where I grew up. But nonetheless, he had indicated that he had mentioned this tax credit to some of his friends that own businesses, and they were not aware of this. The thing to note is that there are a lot of tax pros out there, probably none that are tuned in today. Love you. But there's a lot of tax pros, and they're not dealing with payroll issues. You know, they're focused in on doing bookkeeping and income tax planning. And guess what? I'm one of them. I don't provide payroll services to any clients. I stopped doing that all the way back when I was at the year 5 mark of my practice, which, believe it or not, was 20 years ago, because I've had my own practice for 25 years. But nonetheless, my grandfather, who was a practicing CPA, said, hey, when you have your own practice, stop doing payroll services as soon as you can, because it's a lot of bean counting. There's a lot of technicalities. And he told me this story where he had one of his biggest clients that owned a car dealership, and he was involved in doing their payroll, and in fact, their payroll calculations. There was no such thing as direct deposit and or making payments electronically when this happened. But nonetheless, he would, with his staff, calculate what the payroll was. Well, one of the administrative assistants at this car dealership really raised a stink because for whatever reason, there was a calculation and she made some adjustments for her withholdings. And I'm not kidding, it was about $1 difference. Now, this was a long time ago, so $1 was a little bit more of an impact. But nonetheless, that administrative assistant raised a stink, and that business owner that owned a big car dealership, and this is in California, called up my grandfather and said, hey, Omar, I mean, are you kidding me? You didn't calculate this paycheck correctly, and now I have this employee that's upset and raising a stink. I mean, if you can't do this right, then what else are you missing? Now, maybe that business owner was a little bit facetious, a little bit sarcastic, but nonetheless, it made my grandfather pause to go, what am I doing these services for? That's a really long way to say that your tax advisor really may not be in the payroll form. But here's what I want you to note, is that with the employee retention tax credit, they call it a credit. And somebody was very astute in watching one of my videos related to the ERTC, and they commented and they said, I wish they didn't call this a tax credit, because it really leaves the mindset of it just reduces down taxes, and therefore it's not as sexy, right? But here's the thing. If you get the employee retention tax credit now, you file a Form 941X with a few numbers, you mark it that you want a refund, and they send you a check. They send you a check. They don't even direct deposit it. They send you a check. So I've got a few clients that really were just now kind of able to analyze because of how they keep their books, but really now able to analyze whether or not they qualify based on gross receipts being down. And I've got a client that we're getting ready to prepare 3 different 941Xs for first and second and third quarter of 2021. Each quarter is around a $70,000 tax credit. So that's about $210,000 that my client is going to get a check from the IRS that they'll be able to deposit and use. Now, there's a couple of drawbacks to that in the sense that it is quote unquote complicated to put together the calculation, but for $210,000, something's not too complicated to figure that out. The other thing about it is that in the year in which you deduct the wages that you're using for the credit, then that's the year you need to reduce down wages. What does that mean in layman's terms? Well, this credit is either in 2020 or in 2021, your tax years. And so whatever wages you're deducting in that year, if you got a credit related to those wages in that year, then that is the year that you reduce down that deduction. Now, the IRS came out, didn't tell us about this really until IRS Notice 2021-49, which came out last August. But I'm going to tell you this, if you're an IRS agent, do this for me really quick. Do this, right? Just real quick. I promise I'm not going to say anything. But I want you to remember, tax pros, the rules related to amending tax returns. I want you to remember the rules related to cash basis accounting. And why am I saying that? Well, if you're a tax pro, I'm not telling you to read between the lines. I'm just saying that in a couple of circumstances, I've analyzed this, and I am, in essence, potentially looking at taking a position. We'll have to be maybe ready for it to be challenged, but taking a position in the sense of looking at cash basis rules. So I don't have anything to point you to other than the classic cash basis rules that have been around since the beginning of accounting. And when you look at, in essence, an IRS notice, it is the IRS's, in essence, dictation of their interpretation. Why do people get challenged? Why do the taxpayers sometimes take a different position than what the IRS indicates? Is because in some circumstances, it's not that the IRS is wrong, but facts and circumstances are always applicable to that. So I know there's going to be probably some tax pros right now, and they're freaking out. They're just like, oh my gosh, I can't believe you just said that. Don't worry about it. Okay. I got it under control. Now, hey, if you're with the IRS, you can pull your hands off. And that's all being facetious and joking around, because I know if there was an IRS agent watching, they certainly didn't put their hands over their ears. So Amanda, we're deep into this. Who is on with us? I'm going to turn the mic around to you slowly here. But if you do have some questions related to the ERTC, put them in the comments. We're going to go through these. I am going to go through a few of the slides from my PowerPoint of my ERTC seminar. And so you might also be ready to take some screenshots of the video. You could either pause it if it's on your phone, or get ready to pause it later if you're watching live, and you can take a picture. So you can always rewind and go back to this. But Amanda, who do we got on with us today?
So today we have on Mike Fisher, CPA.
Oh, Mike Fisher, CPA. He also is a part of our monthly buzz, which is my monthly CPE. So I look forward to seeing you on Wednesday, my friend.
Tony D.
Tony D, part of Group 51. Hope you're doing well.
We have Cameron on with us.
Cameron, hope you're doing well, my friend. Thanks for being on with us live.
We have Kevin Hawthorne from Lakeland, Florida.
All right, Kevin. Hope things are going well in Florida. I'm going to tell you this right now. Amanda was showing me some video from Las Vegas. Clearly, that's very far away from you, but strange times. If you haven't seen it, there's flooding in the streets. Usually, we hear about heavy rains, I think, down in places like Florida, right? The tropical areas, if you will, that kind of have these sudden amounts of rain coming down. But by golly, if you're heading to Vegas this week, be prepared. All right, hey, who else do we got?
We have Brady, who has asked a question, so we will get back to that question at the end of the show.
Yes, thank you, Brady. I appreciate that.
Marianne Kenny.
All right. Part of our Group 51. She came to see me in Oklahoma City and brought her family. She brought her husband and her son and her daughter, and we enjoyed cigars back on the porch. And everybody enjoyed some cigars. I'm gonna tell on you a little bit there, Marianne. Hope you're doing well.
Gina Eddy is on.
Gina, how are you? Good to see you. Thanks so much.
Brent Richards.
All right, Brent Richards, my friend. So Brent, back in the day, sent me, and I don't know if I still have it. It's going to be in one of these drawers. Don't worry about trying to find it. But a mask back when we were all mandated to wear them. I know some still are, but it was a Captain America. So anyways, I appreciate that. I've always kept it handy.
We have Greg Roll Tide.
Oh my goodness, Greg Roll Tide. We're getting on that. We got college football season starting up. So I got to probably start saying Boomer sooner. And my son went to OSU last year. So got to say, Pistol Pete there.
And we have David from Connecticut.
David from Connecticut. I tell you what, I saw a movie my freshman year of college that took place in Connecticut. I want to say it was the movie Cousins with Ted Danson. And in essence, they show these beautiful shots of Connecticut. And so for a little while coming out of college, I considered moving to Connecticut to open up a CPA practice. I never visited it, but nonetheless, beautiful country. Thanks for being on.
And then we have Sarah Kay.
Oh my gosh, Sarah Kay down in Houston. Hope you're doing well.
And Greg Cullup, the numbers guy.
All right, Greg, the numbers guy. Thanks for being on with us today. So I'm going to pull up some slides, and because I have these slides, you may not believe this, but I do think it'll allow me to get through these a little quicker. But on this employee retention tax credit, I've got an executive summary. This is one that maybe you do screenshot later. It kind of runs down all the details for you. This is kind of the beginning of my seminar. But what we have now is a summary of the executive summary, which is also a part of my seminar. But see, here's what it is. Okay, it's pretty simple. Go ahead and leave that up for me, Amanda. It's got qualified wages, right, during the qualified period, multiplied by the percentage, and then go get your money from the IRS. So what are qualified wages? It's per employee, and it includes the employer-paid health insurance up to $10,000 per employee. Now, the qualified period is an either or. There's a lot of people that, in essence, are under the impression that you have to be closed and have your gross receipts down. That is not the case. The IRS has gone out of their way to let you know that it's an either or. Now, if you did have a partial or full shutdown, then it matters whether or not you're an essential business. But if it's due to gross receipts, it doesn't matter if you're an essential business. So let's bring that executive summary of the executive summary back up. No, that second one. This is our executive summary of the executive summary. So what's a qualified period? Well, if it's due to shut down, then it's those exact dates. It is not then allowing you to include the wages for the quarter if it's due to governmental shutdown, period. The end. If you've heard differently, unfortunately, it's wrong information. Meaning, if you're shut down for 20 days, then only the wages paid in those 20 days would qualify if it's due to that. But where most are able to qualify, and it then includes all the wages in the quarter, if you're looking at the reduction in gross receipts in 2021, it's 50%. Scratch that. It's in 2020, all right, it's 50%. In 21, it's 20%. And so if you're now looking at what you're comparing that to, it's the quarters in 2019. You heard that correctly. So you're comparing quarters in 21 all the way back to 19, which is before the pandemic. Now you're doing the same thing in 2020. But I want to say it again, you're not comparing 21 quarters to 2020. You are comparing quarters from 2021 to 2019. Let's pull that back up. Now, what is the multiplier there? It's 70% in 2021. 70% of what? It's up to the $10,000 in wages per employee. Now, in 21, that is per quarter, okay? Which means that for one employee, if they made at least $10,000 in each of those quarters, and you qualified in each of those quarters, first, second, and third, due to your gross receipts being down at least 20% compared to 2019, then all the wages for that employee up to the 10 grand are going to be included. That means it would be up to $7,000 for one employee, which would be $21,000 for 2021. Now, if you're a recovery startup business, you can qualify for quarter four. That's simply somebody that has a business that came into existence after February 15th of 2020, and they had $1 million or less gross receipts in 2020. Now, in 2020, okay, it's a 50% reduction compared to 2019. And it's then only for the entire year that you include up to the 10,000. Then you file a Form 941X. Now, I don't want to oversimplify it, but I want you to hear it, that it's simple enough for the amount of money that you can be getting. Now, Tony D's on with me. So in May of 2021, right, all the way last year, my son and I, in his baseball coach, who was also his pitching coach since he was 8, we were headed to Malibu to celebrate. Cooper had graduated high school. So we were, because he was no longer his coach anymore, so no one could say we were looking for favors, to say thank you for all the years of helping out Coop. We headed to Malibu and we went and saw a couple of Dodgers games. In fact, we got to have cigars with Gary Busey. That's a story for another time. But nonetheless, I shot some videos at about 3 or 4 a.m. in the morning, and I miscalculated something, I think, by $20. And Tony D in the comments saved my butt because somebody had said, hey, I don't think you did the math right. Hey, we're all human, right? But here's what I want you to know is that in that video, so if you go to my playlist for the Ertc, you'll see that it is a calculation. I hold up a board. But think if you just simply paid one of your employees $12 an hour and they're full-time, right? So let's just go ahead and do the math together, right? I'm going to pull up my calculator. Just because you're a CPA doesn't mean you should do math in your head. You know why? Because I can't bill somebody for doing math in my head. I need to get on the 10 key. Now, that's a little tax humor for tax pros. If you're not a tax pro, that doesn't seem funny. I get it. But nonetheless, so we're going to say that somebody makes $12 an hour and they work 40 hours a week. So that's $480 that they earn a week. Okay. So I'm going to just assume, I get it. We're doing simple math. Let's just say that in 4 weeks or once a month, that person's making $1,920. I'm not saying that's a good wage. I'm just trying to give you an example of something that's at around $12 an hour. Now, that's for the month, right? So how many months are in a quarter, right? 3. So you're right. I'm doing simple math. So for that one employee, they would make $5,760 for the quarter, right? Using this simple math. The credit, if that employer qualifies, so if their gross receipts are down, then the entire wages to that one employee is going to then qualify because it's less than the 10,000. So we're going to take that times 70% or 0.7, and that's the tax credit for that one employee for that entire quarter, $4,000. So even if you had one employee at $12, how is that not worth doing this for 4K? Like, how much do you make in an hour as a business owner, let's say, or as an employer, right? And let's just say this took you 8 hours. I bet that it would still be worth it. Now, let's just say that that person has 4 of these employees that make $12 an hour. Then that is a credit of $16,128, right? And that's just for one quarter. If this employer qualified for first and second and third quarter of 2021, then we're going to multiply that times 3. That's 48 grand, yo, right? I mean, are you kidding me? Right? Like, that's a lot of money. So this is something to look at. And even with your friends, or you're in Starbs, as my kids call it now, which is Starbucks, but they, call it Starbs. Maybe you're in Starbs and you're in line and you hear somebody talking and they're a business owner. You can say, hey, you need to go check out JJ the CPA, because if you've got employees and you don't have the employee retention tax credit, you should take advantage of it. Nonetheless, look out for your friends. So let's pull back up now that summary of the executive summary. So it's, what are the wages that qualify? It's pretty simple. I just ran through it right there, right? And then what's the qualified period? If the gross receipts are down, it's the entire quarter. What's the percentage? It's just depending on the year. Then you file 941X. Let's go to the simple one. So is it simple? Well, I'm not going to say it's simple, but I'm going to say it's simple enough, right? Get 48 grand. So broke it down for you, qualified wages, qualified period. You multiply it. I more put this up for you to screenshot it. So let's pull that down. We have already some common questions that I've gotten over time. So I've been doing this employee retention tax credit seminar since last year. Many have taken it. If you have, thank you so much. The new seminar that I do have coming out, I've kind of recalibrated how it's presented. I have a couple of new issues that I present, but guess what? The new issues are related to contingency fees, which I'm going to cover today. With that being said, I don't have any new materials or new calculations, but here's what's different about ERTC as I present it now live via Zoom. It's available for CPE, which I'm doing it live this Friday. If you missed it, in the sense of you're listening to this later and it's after August 19th, it'll then be on instant access, but wouldn't be available for CPE on the rewatch. So let's look at the most common question that we're getting, which is how long does it take for the ERC refund to arrive? And right now it's about 9 to 12 months, not even weeks. I'm saying 9 to 12 months. Why? Because there are a ton of employers that have been filing the 941X. That's not a reason not to do this. Now, remember I told you earlier that if you're looking at rules to amend returns, then really know the rules about amending tax returns, right? If you filed it at the time you believed it to be true and correct, then it is. If you come across something that's changed, then how do you rectify that? Is it something that you can do in the following year? Is it something that can follow cash basis? Now, you're right. You know, my friend Brent Richards, fellow tax pro, CPA, I mean, he may be doing this right now, right? I don't know. All I'm saying is tax pros make your own decisions on that. I'm not telling you that across the board I'm doing anything, right? But what I'm telling you is that in essence, there's going to be those that are filing for that 941X now, and they're not going to get the money until 2023. But it may be that they're having to make an adjustment to 21. It's not a reason not to do this. All right, let's go to the next one. Can you get ERTC if you got PPP? Can you get it if you already got PPP forgiveness? The answer is yes, but not on the same wages. Another common question is, do you have to use PPP before ERTC? No, there are no ordering rules. What I want you to know related to this is that when you get PPP, if you've already filed for PPP forgiveness, then whatever wages you put on that PPP forgiveness application are locked for PPP loan forgiveness purposes and are not available for ERTC. Now, you have to hear me correctly. And if you're watching me live, you know who I am and you know that I'm not trying to give you something that's sneaky, wink, wink, with a smirk that's going to get you in trouble. Because as a CPA, a certified public accountant, I can't do that, number one, and I'm certainly never going to recommend anything for anybody to get in trouble. But the reality is this: when you complete the PPP loan forgiveness application, you're not submitting anything with specifics. You're just submitting a total for your payroll costs. Now, don't think all of a sudden I'm telling you it's wild, wild west and you can do whatever you want. What I'm telling you, though, is that you are allowed, and the IRS said you are, as well as the SBA. Well, where did they say that? Google ERTC PPP. You're going to find it. Do just that little bit of homework. Go right to the PPP loan forgiveness applications and look at the additional language that they give you after the form. Like, it's still a part of that PDF, and they talk about it there, which is this. You know that PPP, right, is a covered period of 24 weeks. You can pick any time period to, in essence, use wages for PPP loan forgiveness. It doesn't have to be at the beginning of that time period. I also want you to remember is that with ERTC, it's only up to $10,000 in wages, where with PPP, it's up to $46,153 of payroll per employee that can be included. Now, for those that are 5% or more owners, that would be really your S Corp owners, they only get $20,183 included. All I'm saying is this: it's going to be probably pretty hard for you not to qualify for max PPP loan forgiveness and max ERTC. So with that being said, let's talk about the due dates. That's another big question that we get. Hey, how long do we have to go and get this money? And here is some great news. So this is directly from the 941X instructions. And if you link, go to the, if you go to irs.gov, you put in 941X, you go to the instructions, you will see in there, when do you have to file this? What's the, in essence, drop dead due date? And it's this. It is 3 years from the original due date of Form 941X. Now, there's some other language in there that it's within 2 years of when you paid the tax, but it's the latter of. What does that all mean? Let's pull that back up. What this means is that if you do qualify in second quarter of 2020, then you have all the way until July 31st of next year, 2023, to file 941X, and it goes from there. So if you qualified in first quarter of 21, you have all the way until April 30th of 2024. Now you might be saying, well, wait a minute, those due dates don't make any sense to me. Don't worry about it, because right now we're in 2022. If you're watching this in early 2023, you have time. But those are just simply the due dates of the payroll forms. It has nothing to do with the due dates of your income tax returns. Now, this one's going to be a little controversial, but I did listen to a podcast by the AICPA. Now, I don't know that I can give you access to the podcast, but nonetheless, let's go to the contingency fee slide there for the AICPA. Facts with any contingency fee related to tax services. And the bottom line, without me reading this all to you, is that you are not allowed to charge a contingency fee related to these tax services per the AICPA. And Ed Carl, who's the vice president of the tax policy, has a podcast, and he lays it out. Now, why is that, though? Because you may be like, what? Right? Or you may be like, well, that's not right. You may have some emotion related to that. I'm not here telling you what you can and cannot do. What I'm telling you is what the AICPA has said. And here's the thing. When we talk about the contingency fees for CPAs that have to follow AICPA rules, right? The only way you can charge a contingency fee, let's pull that back up, is if you're providing a service that there is an expectation that there will be substantial review of the position being taken, or a position already being challenged by the IRS. So the IRS has their own saying that we're going to look at, but in section 1.510.010.05, an example of when contingent fee is not permitted. A contingent fee is not permitted if a member prepared a client's amended federal or state income tax return claiming a refund of taxes because a valid deduction was inadvertently admitted from the original return. Now, we could argue, well, was it omitted or the law changed? What Ed said in this podcast, and in my opinion, he represents the AICPA directly, is there's no substantial review expected from the IRS. It's just going to be processed, that Form 941X. There's not enough information provided with the 941X, quite frankly, for the IRS to actually even know if the calculation is correct, other than, in essence, the math of the wages. But in terms of what employees, what dollar amount, none of that is on the 941X. So all I'm saying is there is no substantial review of that. And so the AICPA says no to contingency fees. Now let's look at what the IRS says, which is the Treasury Department, right? Now, whether you're a CPA or an EA or a tax pro or somebody doing this on the side for fun, for a hobby, you have to follow Treasury Department Circular 230. And the bottom line is that it's consistent with the AICPA. A practitioner may charge a contingent fee for services rendered in connection with services of an examination or challenge to. Okay. Filing an amended return, right, doesn't rise to that level. So check those things out. Let's pull it back up one more time, Amanda. So if you go to Circular 230, it's in section 10.27. Just go to irs.gov, put in Circular 230, put in, look for section 10.27, read it for yourself. In essence, contingency fees are not allowed. All right. Hey, I'm not going to go through really any other details, but I do want to just show you a couple of the slides that if you're taking my seminar, we walk through how to calculate your gross receipts. Now, if you want to take a quick screenshot of that, but it's comparing your gross receipts for the quarter all the way back to 19 to see if you're then qualifying. We also talk about aggregation rules, right? Kind of getting down the minutia, which is for those that own several businesses. Now, I'm going to tell you this. You have to aggregate businesses that you own, whether they're an S Corp, a C Corp, a partnership, filing a Schedule C or a Schedule E. Doesn't matter if they're in different states. It could have various owners. Pull that back up one more time. But the key here is that it's 50% or more common ownership when you're looking at aggregation rules. Now, next slide here that's in my seminar is looking at doing an analysis to max out, in essence, your PPP and your ERTC. So I give you spreadsheets related to this and calculations, Excel spreadsheets, walk you through the calculations. That's all included in this seminar. In the body of this video, there's a link to that. If you join me live, then you'll be able to get CPE for that. So real quick, because I want to get to the questions, but I've got a number of seminars. Just flash them up there if you don't mind. I got a monthly seminar. It's just 1 hour. It's a flat fee for the year of $97. I've got a federal individual tax update. I've got a business and individual, as well as then a federal business tax update available for CPE. So bottom line is I hope to see you at those. You don't have to be a CPA or an EA to be a part of this. Now, Amanda, do we have any questions? I think you had mentioned that somebody, and I'm going to tell you this right now, because I'm looking right here and we're at 36 minutes. I got 37 minutes, right? And we have covered a lot of ground. Now, I do have a whole section talking about this in my seminar, but I would be remiss to tell you that the IRS was clear in IRS Notice 21-49 related to owners, right? This isn't going to be popular, okay? But it's been around now for over a year. But if you are a more than 50% owner, you don't qualify unless you don't have any living relatives. That's code section 267C, right? Yeah, you become a code head after 30 years in the biz. The other thing I want you to note is that if there are family members living, it doesn't matter if they work in the business or own the business, you have to add up all the family members and their ownership. And whatever that total is, each family member is deemed to own that percentage. What? Huh? What does that mean? What? Simple example, okay? You have a dad that owns 20% and a mom that owns 20%. And if no other family own that business, well, they're less than 50% owners and their wages as owners can be included in the ERTC. But if you throw in that their son owns 5%, and their daughter owns 5%, they collectively own 50%. But guess what? For this rule, majority ownership is more than 50%. So in that example, all would qualify because they own 50% or less of the business. So their wages as owners would be included. But if you now included grandpa owns 1%, grandma owns 1%, now, collectively, that family owns 52%. Now, right there, you can get argumentative and like, whoa. You talking about father and the mom? They don't. I mean, they what? No. I'm telling you, Code Section 267C. It's an IRS Notice 2021-49. Go look it up. They have a whole section to talk about payroll to relatives. Each one of those family members for ERTC purposes is deemed to own 52%. So that means none of them qualify, period, the end, okay? Now, there's an example that the IRS gives you. You have a person, they use an example of a father, okay? And that father owns 100%. If that father, meaning their father because they have a son, if the son is living, so let's say that's their only living relative, the son is living, they don't qualify, period. But believe it or not, this is what's weird about the tax law. If that 100% owner does not have any living relatives, right? It includes the code in 267C says ancestors, right? If there are no living relatives, then that 100% owner qualifies. So it's going to be in the slimmest. All right, we're at 40 minutes. What questions do we have? I'm going to do this. I'm going to, as you're asking them, one day we might have dual, right, screens. Yeah, it might be like we see other talk shows where it pans over to them one day. But anyways, I'm going to turn this to you. Go ahead and ask the questions, and then I'm going to do my best to answer them.
This is from Brady. Can you take a minute to review qualified wages when PPP forgiveness was granted?
Brady, I love it. So Brady, right, is the name of my nephew who is a total stud. I was at my sister's daughter's 1-year-old birthday party. And my other sister, whose oldest son is Brady, is 5 years old. And he's kind of a suave guy, like, dresses well, likes to dress well, likes to pay attention to his hair, kind of probably runs in the family. But nonetheless, there was another guest at this birthday party for my niece that was turning 1. And they didn't know Brady, his 5-year-old. And they said, hey, how old are you? And he says, well, why don't you guess? And she's like, are you 9? And he's like, yes. And she's like, you're 9? And he played it off. He played it. I mean, this guy is going to be a player. He is ahead of his time. So we're already got the warning whistles up with this kiddo. He's going to be a heartbreaker. And all to say, I love the name Brady. I hope you're doing well. So yes, we talked about it a little bit. I know you asked your question before I covered it, but really for the most part, I bet a lot of you have already gotten PPP loan forgiveness, right? I know that if you were watching my channel, I was saying, hold your position all the way through 2020. Hold your position. And even in early 21, I said, hold your position for getting PPP loan forgiveness. But we know that PPP loan forgiveness, the deferral of the payments is 24 weeks plus 10 months. And then payments come due, even if you haven't filed for PPP loan forgiveness. Now, if you filed for it and you got it, of course, there's no loan payments. But all that to say that starting about May and June and July, and now probably a lot of you, the banks have been hot and heavy to get your loan forgiveness application in. Here's why I'm going through that with you is that with the PPP loan forgiveness application, when you look at the form 3508, the 3508EZ, and the 3508S, in every single one of those applications, when you go to that PDF, which is just right at SBA.gov, you go to the PPP, they have a page on PPP loan forgiveness, you click on it, you find right there these instructions. You look at any of them and it's consistent across the board that the SBA indicates specifically that any wages that are used for PPP, you can't use for ERTC. Now, why am I pointing that obvious out to you? Well, when you're filing for PPP loan forgiveness, when you're now looking at that application, you're just putting a total. You're right. If you're doing the full 3508, right, you're including a lot more information. The EZ, it's less. And in the 3508S, it's really a few numbers. So with that being said, whatever you put down on that application as payroll costs, no matter what version you're using, that's the dollar amount in total that, in essence, you're stuck with. But some good news related to that is this. So I know that in the early phases, many were filling out the PPP loan forgiveness application, and they just put the total payroll that they had in the covered period, meaning that 24 weeks, down on the payroll forgiveness application, meaning they just said, hey, here was my total payroll for that period. But their PPP loan was way less than that. Remember, PPP was really only covering 10 weeks, right? It was annual payroll divided by 12 times 2.5. That was the amount that you got, which is for 10 weeks. You had 24 weeks to use it. So most people have way more payroll. So the good news is when you're now looking at, well, how much payroll then is deemed for PPP loan forgiveness? If you just put down the massive number, well, it would be no more than what your PPP loan is. SBA and the IRS have been clear on that. So you may have gotten full forgiveness because you had plenty of payroll. And on your PPP loan forgiveness application, you may have had so much payroll that you're like, yeah, I'm not going to put down rent or utilities or interest. So what you need to know is there's not going to be the ability to go and amend your PPP loan forgiveness application to now take advantage of including those other expenses. So you're stuck with whatever you filed with the SBA. But I say stuck with as in the total amount. So let me just say that real quick again. Whatever your PPP loan is, no more than that amount is deemed then for payroll, in the sense that now you can use the rest of it. The other thing is the IRS made it clear where. Go to irs.gov, put in the PPP, you're going to find it. Okay, so in my seminar, I have a whole section about this, and I provide the links to all of this. But all this to say that there's no ordering, right? You may think there's ordering. You may want there to be ordering. You may be like, well, that doesn't sound fair. Well, I've said forever, the IRS and the tax law, as well as the SBA, it's not about what's fair and what's unfair. It's just the law. It's just the rules. Don't hear me as now I'm giving you something to go and take advantage of something. No, I'm not saying that at all. What I'm saying is they've been very clear that if you have wages that qualify for both programs, you get to pick which one you want it to qualify for. Now, remember this, 24 weeks, right? That's almost 6 months, almost, right? There's 52 weeks in a year, right? So half of that would be 26. So 24 weeks is almost, right, 2 quarters worth. And I want you to remember this, PPP, you didn't get it at the beginning of the quarter in quarter one, if that's when you got it. So you probably have PPP, your 24-week period, that's maybe a lot in quarter one of 21, maybe all of quarter two, unless you, for some reason, selected the 8-week covered period. And it probably spills some into third quarter. So that's the first thing to note. The second is, I told you earlier, up to $46,153 in wages per employee can be included for PPP loan forgiveness. So let's just say for grins that you look at one employee, it's like, well, if you use 10,000 of those wages for ERTC in first quarter, and you use 10,000 of theirs in third quarter, and you used a second quarter and third quarter. So let's say that you use the 10,000 per quarter for this one employee, meaning you used up 30 grand. Well, right there, it's like, well, there's 16,000 left over, right? Just on that alone. But also remember, those things don't, in essence, eat out each other when we're talking about the allocation of employer-paid health insurance. So you could allocate all of the employer-paid health insurance to PPP loan forgiveness, the 30,000 over to ERTC if you qualified for all 3 quarters, and still have 16,000 in payroll in this example. The other thing to note is that, what did I say earlier? We have 10 weeks of PPP money, 24 weeks to spend it. It doesn't mean that it's an ordering. What it means is that you can't, in essence, use the same payroll for both programs at the same time. Now, no one would probably get down to this, but we have a good friend out in California, Parm. Haven't seen her in a while, so hope she's doing well. But nonetheless, I know that Parm consulted with her a few times, and they were getting down to this nitty-gritty. So hear me on this, okay? When we're talking about the payroll for employees, right? There can be a specific day that all the wages for one employee were used for ERTC, and all the wages for another employee were used for PPP loan forgiveness on the same day, because it's not about payroll periods. It's not about in total. Remember, it's per employee for both programs. So you might have a situation where you have different pay for your employees, right? So there could be an employee, and it's like, oh, we already used up to 10,000 for their wages quicker. So then anything after that's going to PPP for a lower wage employee. It's going to take longer for them to get to the 10,000. And so my point is that you can have a day with payroll for different employees being used for different programs. Now, it could get literally down to this minutia, right? You could get down to the minute, but most businesses maybe get down to the hour, right? Hourly rate. But you literally can have an employee that on a specific day, they could have 7 hours that are used for PPP and 1 hour used for ERTC. That doesn't seem right, JJ. Then you just haven't read it yet then, or you haven't taken my course. And all I'm presenting in the course is what you can go and get at irs.gov. Check out all that information there. So at the end of the day, I've not yet once come across a calculation where we've not been able to max out PPP loan forgiveness for a client and max out ERTC, even when they qualified for both first and second quarter of 2021 for the ERTC, even if they qualified for the third quarter. Let me give you one little example, and then we'll see if we have any other questions. But think if we have someone with a covered period of 24 weeks, right? It's most of first quarter, it's all of second quarter, and it's a little bit of third quarter. This would be in 21, right? Because it's just 24 weeks for the covered period. That means that when they get to third quarter, it's like, well, I mean, once the covered period is ended, which is probably like somewhere in August, right? Well, the rest of that quarter can be used. And you said, well, JJ, you just said there's not ordering rules. Well, there's not ordering rules, but you may want to use some ordering rules in the sense of, well, we're going to use this payroll at the beginning of the third quarter because we need it for PPP loan forgiveness. But then anything after that, we will be able to use for ERTC. But guess what? Yeah, that 24 covered period, I bet, because this was the case for most of my clients, within about 10 to 11 weeks, maybe no more than 12, they already achieved PPP loan forgiveness. So let's just say that someone doesn't qualify for ERTC in first or second quarter of 21, but they qualify in third quarter of 21. Then they could use all the wages in third quarter. They wouldn't even have to worry about PPP. So definitely need to take a look at that. Brady, thanks for the question on that. Appreciate you.
All right, our next one really isn't a question, but it's a good comment, so I'm letting you know. It's from Gina.
Gina.
She said, spoke to a friend about ERTC last week. He's looking at a credit over 200,000, so it's worth mentioning. I'm helping him, so I took JJ's seminar this weekend to be sure we get it right. And then she followed up by saying, bought JJ's seminar last week, includes video, sample spreadsheets, comprehensive PowerPoint, links to regs, you name it. If you need help, I highly recommend it. So thank you, Gina.
Well, Gina, I really appreciate that. And for such a wonderful plug, please email me as soon as you can, jj@jjthecpa.com. Gina, we're going to know that it's you. If your email doesn't identify you as Gina, in the regarding line, say, hey, I was on your live, but I want to give you a link to the upcoming ERTC. No new materials, but I'm retweaking the presentation of it. If you want to get the latest version of it, also available for CPE. So I'd love to give you a complimentary seat to that seminar. So thank you so much for that. I really, really do appreciate it. What else do we got, Amanda?
So our next question's from Sarah K. How many hours does an employee have to work per week in order to get the tax credit?
So the good news is that there is no minimum. So there is some discussion related to this. There could be some misunderstandings. So let's really break this into two things potentially where the misunderstanding can be. First and foremost, you can have someone that's like, well, they just worked a day and they never came back. Those wages, if it's in essence during a period that they qualify, then they're going to be included. Now, if you are an employer that has more than 500 employees in 21 or more than 100 employees in 2020, you would only be able to include employees' wages if they did not provide services. Now, probably for most that are tuning in to my channel, you don't have that big of a number of employees. If you are, I love it. I don't mean that as any insult. All I'm trying to say is that shouldn't worry any of you. But where there could be some misunderstanding is when you're then determining your head count, right? Because I just told you if you're 500 or less employees in 21 or 100 or less employees in 2020, then there's different rules. And the different rules are you just get to include all wages for all employees. The thing I want you to note is that when you're calculating the head count, that is where there is potentially this misunderstanding, because you don't have full-time equivalents. You're literally only including full-time employees when you're determining the head count, but the head count is only for determining, are you a large or small employer? That's it. What it does not mean is that you exclude your part-time employees or those that are only working a few hours. So if you have somebody that works, 4 or 5 hours a week, right, for whatever reason, 100% you are able to include those wages. So great question on that. I appreciate it. What else we got, Amanda?
So our next question is from Greg Cullup, the numbers guy.
Let's go, Greg, the numbers guy. I appreciate it.
If we have a client who does not qualify for ERTC on decreased revenue, but would based on a government order, how do we determine when the government order ends?
So great question on that, in the sense that I talked about it earlier, but just as a quick recap, basically it is an either or, which Greg knows. But what I'm saying is if you are shut down and you do also have your reduction in gross receipts, you would just probably go with reduction in gross receipts because it's for the entire quarter. I'm going to say that in another way. If you're due to governmental shutdown, it is only the specific time period in which wages were paid during that time period that you get to include to calculate the ERTC. Meaning, if, like in Oklahoma, we had a shutdown 21 days, it was at the end of March, and then to the beginning of April, right? So 100%, that does not qualify an employer for all of first quarter and all of second quarter, period, the end. Now, what to Greg's question, numbers guy, how do we know? So what the IRS goes out of their way. So if you were to look at the IRS notices that the IRS has put out related to this, especially back in 2020, then you're going to see they went through and did massive number of Q&A related to that. Now, if you go to some of my early ERTC videos, I give links to these IRS notices, but nonetheless, what the IRS indicates is that when that is officially over, so unfortunately, you're going to have to dig, and the IRS points out that there's no nationwide or statewide per se that dictates it, in the sense of it's just whatever jurisdiction they're in. So I don't believe we had any national closure mandate. There were states, though, that said, hey, it's a state mandate. So then that is the higher mandate. Therefore, that's what you would go to. However, I know in the state of Oklahoma, the state was not as strict, but then some of the counties were more strict and some of the cities were more strict than the counties. So what it comes down to is what the IRS has indicated is you have to go to their jurisdiction and you have to look at what were the requirements. Now the IRS goes out of their way to say it's not if there's a suggestion, it is if there's a requirement. What's the requirement? It would have to be literally a governmental order that is signed by whoever is the top official for whatever jurisdiction is ruling that closure, if you will. Now, I want to be clear, it includes partial or full in essence. Now, many want to think that if you're an essential business, you just don't qualify. The IRS spends more time, this is beyond Greg's question, but the IRS spends more time convincing you that essential businesses still qualify than they do pointing out how non-essential businesses would qualify. So what are some of the ways that an essential business would still qualify? Well, one is if they also have non-essential types of revenue streams. So the IRS literally gives an example in one of their IRS notices of a hospital. This is an IRS written example. You have a hospital that also has a pharmacy. The pharmacy is closed, it's considered non-essential. The hospital clearly is essential. But because in this example, the pharmacy's total gross revenue is more than 10% of the collective gross revenue of the hospital and the pharmacy, then that entire business is not considered essential for ERTC purposes. Now, if you're going to, well, that doesn't sound right and blah, 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 just go read it. Just go read it. Our job is not to find ways not to qualify as a tax pro, right? It's just to interpret the law. I'm just telling you, that's what it says. The other aspect is that there is no classification of essential and non-essential employees. That got dreamed up by somebody. Somebody came up with that on their own that has nothing to do with anything that has been put out by the IRS. There is no classifications. Either the employer is an essential business or not. The employees don't dictate it. The other thing I want you to note is that the IRS goes out of their way also to indicate that if you have an essential business, but its vendors, in essence, were closed down, and then in fact, though, were not able to provide anything or, provide goods, if you will, maybe even services to that business, then that essential business can make an argument that they qualify for ERTC. Now, the IRS does indicate, though, that whatever effect there is on a business's customers does not then somehow qualify a business. So if you have customers and you're like, well, all my customers were shut down, right? That's not a qualifier. But if you're like, oh, well, my vendors or some of my vendors, okay, they weren't able to provide, then that's enough of a way. So back to Greg's question. So in Oklahoma, basically, we went to the Oklahoma governmental website. We found the order, and it included then also an order when it ended. So I would recommend trying to find that or have your client find it to help you out related to that. So good question on that. Appreciate you.
All right, our next question is from David, but I believe you just answered it. Does the stay-at-home order for non-essential employees count for government shutdown? Seems a little unclear right now, but you just went over all of that.
Yeah, and I am just going to add, if you go to the IRS website and just put in the ERTC, they have a ton of FAQs. Now you're going to see at the top of the screen that says some may be outdated, but then they give you a link to IRS notices that are then in essence, the updated version. So they go out of their way. Check out those IRS notices. They have tons and tons of examples of just what you're talking about. But in my opinion, it is super clear. There is no classification of an employee between essential and non-essential. It is crystal clear. There is no classification when it comes to ERTC.
This next question is from Kenneth. Do 1099 employees qualify for the ERTC?
So unfortunately, they do not. The IRS is crystal clear on this. Same thing in the IRS notice. They literally list that as a question. They provide the answer, and it's no. And the reasoning is that this is only for employees, as in W-2 employees. So for those that are paying people on a Form 1099, and they call them employees, I would caution you, because an employee has to, by law, be paid on a W-2, but it's just like with PPP, it did not include those that you paid on the Form 1099.
Next question is from Greenfire 919.
Greenfire, I love it.
What is the minimum number of employees for ERTC?
Great question on that. No minimum at all. So you could have one employee, and the example I gave earlier, you might be the one employee of your S Corp, and if you have no living relatives, your wages then qualify up to the $10,000. Now, if you have living relatives, you don't qualify as 100% owner, but there is no minimum in any way, shape, or form, and there's no minimum amount of payroll either. So great question on that.
Brady asks, can you go over essential businesses that don't qualify for the 50% or 20% gross receipt reductions?
So great question on that, because the IRS also goes out of their way in the IRS notices to indicate when you're now qualifying due to gross receipts being reduced by whatever percentage is required, 50% in 2020 or 20% in 21. They make it crystal clear that that has nothing to do with that employer qualifying due to gross receipts. So for any of you that are listening in, go check out the IRS notices. I mean, it's there in black and white. They have a question, they have an answer. You can't mistake it, okay? They even have it in multiple languages if needed. Of course, I'm being a little sarcastic there. But all I'm saying is this: when it's due to gross receipts being reduced down, okay, the essential, the non-essential has nothing to do with it, meaning it is nowhere in that hemisphere or sphere or universe. It is simple. Were the gross receipts down? Yes. They qualify, period. Now, if they're 500 or less employees, it's all the wages up to 10,000 per employee. If they're more than 500, this is in 21, then it's only the wages paid to employees that didn't work. But you just simply qualify. Great question.
All right, our next question is from Gina from the seminar. Please confirm if Q4 2020 versus 2019 was down 28%, so doesn't qualify for ERC in Q4 2020, those figures can be used as an alternative calculation for Q1 2021 to qualify, correct?
Absolutely, you are on point, Gina. So what's neat about this, and it's covered in the IRS notice that the IRS came out with in 2021. There was 3 of them in an IRS procedure. Not to keep plugging my seminar, but I give links to all that, as Gina was kind enough to mention that she just recently took it. But when you go to it, and I want to say, Gina, it's in the, I want to say it's 2021-23 potentially. It doesn't matter. It's in one of the notices, but I think it was in the second notice that came out that year. But they really cover in detail the alternative method. They also address it again in 2029-49 IRS notice. But what they cover in detail is this alternative method. Now, we have to be careful about this. And so it's a great question. I'm going to run through this. If somebody qualifies in first quarter of 21 because their gross receipts are down at least 20% compared to first quarter of 19, then they qualify in that quarter. Boom. But what if they're not down? This alternative method is just what Gina had indicated. You get to look at the preceding quarter. What does that mean? So in this example, if they did not qualify in first quarter of 21, meaning they were not down at least 20%, then this alternative method allows them to look at fourth quarter of 2020 and you compare it to fourth quarter of 2019. And so in Gina's example, she has a client that they're down 28% in fourth quarter. So they weren't down to 50% to then qualify in fourth quarter unless they had a carryover from an earlier quarter under the 2020 rules. But nonetheless, because they're down 28% in fourth quarter 2020 compared to fourth quarter 19, then they qualify for first quarter of 21, all the wages, etc. Now, here's the thing. When you get to second quarter, because they did qualify in first quarter, that doesn't automatically qualify them for second quarter, because what the IRS makes clear in the IRS notices is that each quarter is a standalone. So let's just take this example one step further. Let's say with Gina's client that for second quarter of 2021, they were not down at least 20% compared to second quarter of 2019, right? Well, what was the preceding quarter? It would be first quarter. So if the actual first quarter of 21 was also not down at least 20% compared to first quarter of 19, they're not going to qualify in second quarter. Meaning, when you look at the alternative method, Gina gets this. This is for everybody else's benefit. When you look at second quarter, just because they qualified for first quarter doesn't mean they automatically qualify for the second quarter. You have to look at, do they qualify literally in the quarter? No. Then in the prior quarter, literally, were those gross receipts down? No. Then they wouldn't qualify. So I covered that in the seminar as well. So thank you for that, Gina.
That is it.
Oh, great. Well, we are sitting good. We're an hour and 9 minutes. I think it was at about the 40-minute mark that I really did wrap up what we were kind of covering and walking through. If you came in late, know this. I threw up some slides from my seminar that you could go back and screenshot. I do a nice executive summary related to that. But anyways, thanks for tuning in. Listen, next Monday when we go live, I think we might be in the car, right?
Okay.
I think, oh, you know what? We're going to have to change our time. We're going to be actually at a concert that starts at 4.
Yeah.
So I'm going to give you a hint. It's not a, you would think if it starts at 4, it's for old people that might be playing the violin, you know, which I enjoy that kind of music, right? It's not. Okay. It's not one of those concerts. It's a mega concert nonetheless, right? So we will find an alternative time. I'm going to tell you this next week. I'm so honored. I'm going to be speaking to a ton of CPAs out in Atlanta on behalf of the Georgia Society of CPAs. So these seminars that I'm indicating that you can go and attend will be the same seminars that I'm presenting to some wonderful folks out in Atlanta. So we're flying there, and we're going to be in Atlanta, I think, 22 hours. So we're headed to Dallas. We're doing a meet and greet with a CPA firm down in Dallas. Then we're going to this concert. Then Tuesday, we're flying out to Atlanta. On Wednesday, I'm presenting that morning. We fly back to Dallas Wednesday afternoon. We drive back that night. Thursday, okay, this is the following week, I'm doing a seminar for you. So check that out. It's at 1 o'clock. That would be on the 25th. And then Friday, I'm presenting the ERTC seminar to my home crowd, which means to the Oklahoma Society of CPAs. Very excited about that in person. So doing some in-person seminars, kind of unusual. Used to do those a lot near year end. Amanda and I had a stretch at the end of 18 where I think it was the end of 18. No, it was the end of 19. 3 weeks we were gone. It was so fun. We went from New York to Colorado to Wyoming to Texas to Seattle to Oregon. Oh, it was so fun. That was on behalf of Surgeon. So they paid for it all. We got paid to go. That was a ton of fun. We hit 50 cities. What? Now, since the pandemic, we've done everything by Zoom. So I'm a little excited to get out. The only time we've done any in-person speaking since the pandemic was to the great CPAs in Nashville, Tennessee in January. And we just got invited back to next January. So we're excited to go back to Nashville. So anyways, with that being said, looking forward to next week. Got a lot of seminars coming out for y'all. If you happen to be Atlanta, check those out. And then with that being said, the next live seminar, so we'll obviously announce when that is, but I want to dive in on Q&A on the auto deduction, right? It seems juicy. I'll tell you this right now in closing. I have clients that we talk about their tax estimates, maybe big taxes, maybe small taxes. I have clients that, we're walking through some details of buying and selling their business. Maybe we're talking about, should they hire somebody or should they push or pull income? A lot of tax strategies that could come into play. But typically with my clients, I'm calling them. And I'm saying, hey, it's time to get together on this, or hey, I'm following up on this, right? I'm not pulling teeth, but I'm the one following up. But I'm going to tell you this, on a Saturday afternoon, right? This phone rings. Hello? Yeah. Oh, yeah. You're buying a car. You're on the car lot right now, right? Oh, yeah. Meaning buying a car ends up somehow being the most important decision that clients are making. Oh, I want to do it right now. What I do tell my clients is this. Just drop this little, not JJ the CPA, just drop this for your salesperson, for the finance manager, right? Just drop this little sentence. I need to check with my CPA on that. Excuse yourself. And then it was, oh, they're checking with their CPA or their EA or their tax bro. They're checking with their accountant. Oh my gosh. Yeah, the finance manager should be saying that. Nonetheless, I'm just having fun to say this is a hot topic. I'm going to have a video coming out. It will be a little different in the thumbnail because it's just going to have a picture of a green Range Rover, and it's going to talk about the auto deduction and something that's expiring this year. The 100% deduction is expiring this year under the bonus depreciation. What? That's a little teaser. Come check out the next live. We're going to do a Q&A again. This was a lot of fun. Thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. All right, who do we got? We got to say goodbye to people. Is CSR on with us?
CSR is on.
All right.
Stacy Swanner.
Stacy. Tony D.
Fisher,
Mike.
Sarah K.
Sarah K. Thank you so much for everybody. Thanks for the questions. Gina, thanks for taking the seminar. For the plug, do email us so I can send you a link to that if you'd like. And you don't have to attend live. You can have access to rewatch that later. I do have a few updates to a few of the links, but nothing's material. I want to thank Brady for the questions, Greg, the numbers guy, for those
Sarah
of you
K.
that, Sarah K, thank you for that. So anyways, really appreciate y'all. And I look forward to seeing you on the next live.